Welcome to a brand new episode of the monthly economic update for the month of August. In this video, I will briefly explain you the latest developments in the domestic economy, as well as I would like to share with you few insights on the outlook for the next few months. Let's start with the real sector. As you can see on the screen, the Purchasing Managers Indices covering manufacturing, services as well as construction shows that all these economic activities are growing. Looking at the Industrial Production Index, it's clear that the performance in this year is better than last year and the year before. These indicators suggest that the economic outlook for the near term is optimistic, while remaining cautious about the uncertainties in the global economy. With the recent monetary policy review of the central bank, they have released their projections for the economic growth for 2025. Accordingly, they are expecting the economy will grow around 4.5% this year. However, this projection considers risks such as US tariff-related uncertainties, which could affect our external sector performance, market conditions, as well as our investment. And potential geopolitical tensions could also reduce our external demand and also negatively impact on our tourism, foreign employment, as well as remittances inflow. Weather-related factors could also affect our agriculture sector as well as the food supply of the economy. Next, we'll have a look on what's happening with the inflation. As we all know, Sri Lanka experienced a deflationary situation during last few months. In March this year, the deflationary situation started easing. However, this inflation is still in the negative territory, but the deflation eased further to 0.3% in July. This easing was mainly driven by food inflation and the upward revision of electricity prices in mid-June. Looking ahead, the central bank expecting that this deflation turn into positive during the third quarter of this year, and the inflation will further increase in the fourth quarter. Since November last year, the central bank introduced overnight policy rate as their key policy tool for the monetary policy. In May this year, the policy rate was cut by 25 basis points and thereafter it remained unchanged. With the accommodative monetary policy, market interest rates have significantly declined. Although the interest rates have fallen, the spread between deposit and lending rates still remains high. The central bank expects this spread to normalize and interest rates to fall further in the near term. With the low interest rate regime, the credit to the private sector by commercial banks has grown up significantly by 13.1% in July this year. Credit is flowing broadly across all major sectors. This faster growth could create higher than expected demand pressures on the economy. Central Bank is expecting this credit growth trend to continue in the near term. Looking at the demand for loans, as a result of the low interest rates, as well as the resumption of motor vehicle imports and improved macroeconomic conditions, loan demand has picked up significantly. You can see on the screen, during the second quarter of this year, loan demand picked up remarkably. The central bank expects further growth in loan demand during the next quarter, that is third quarter. Looking at the external sector performance, both exports and imports have improved during the first half of this year. As of that, exports rose by 5.7% while imports grew by 12.4%. Out of the $9.7 billion import bill, $475 million were spent on motor vehicle imports. That includes $360 million for personal vehicles following the relaxation of the import ban. As a result, trade deficit widened to $3.3 billion. Services export grew by 8.1%. Tourism earnings also picked up by 10%, and worker remittances rose significantly by 19% compared to the first half of last year. Vehicle registrations also increased in line with higher imports. In July, 35,232 vehicles were registered, including pre-owned and brand new vehicles. Motor bicycles made up the majority, followed by SUVs, crossovers, and motor cars. In the fiscal sector, we can see a significant improvement in the fiscal performance. Total revenue and grants recorded a significant growth during the first half of this year in comparison to the last year first half. This was mainly driven by higher tax revenues, particularly VAT, income tax and excise duties. Expenditure and net lending has also increased mainly due to higher spending on subsidies, transfers, salaries and wages, as well as interest payments. As we know, there are three key revenue collecting agencies for the government. Those are Sri Lanka Customs, Inland Revenue Department, as well as Excise Department. All three agencies achieved close to 50% of their revenue collection target in the first half of this year. The total revenue target of the government for this year is 4.6 trillion rupees, and the government has already achieved 47% of this given target during the first half. Finally, these are the 6 key take-home messages for you all from this economic update. The economy is gaining momentum. Growth is expected to reach around 4.5% in this year. Inflation is moving out of deflation. Loan demand is also on the rise. External sector remains resilient and the fiscal performance is also improving. I hope you find these insights useful. See you on the next economic update. Thank you for tuning in.